This is 93 Million with Doug Andrew. Welcome to 93 Million with Doug Andrew, where we talk about how to optimize your assets, minimize taxes, and empower the three dimensions of your authentic wealth. My name is Greg Dukowitz, your host, facilitator, IUL specialist, and lover of smoked meats. And in today's show, we're covering getting out of debt, getting out of government debt, and the difference between tax-free and tax-deferred. And we're joined by the OG of properly structured IUL, author of the L.A.S.E.R Fund, and a man who teases those he loves, Doug Andrew.
Great to be here, as always.
The master of the max-funded IUL, co-author of the L.A.S.E.R Fund, and a man who makes a mean ebel-skeever, Emran Andrew.
Thanks to my grandma. Thanks to my grandma Jolly.
And a featured host, one of the original converts from Whole Life to IUL, the president of L.A.S.E.R Financial, and one of the top IUL specialists in the country, Brandon Johnson.
Great to be here. Let's do it.
And also featured host for today, also top IUL specialist in the country, and a man who shares a birthday with Earth Day, Scott Reynolds.
Yes, and Brandon and I are actually the Laurel and Hardy of IUL. So.
Yeah, we want to excuse Aaron today, who can't be with us today. So, gentlemen, lots to get to. Let's just dive right in. I'm really excited about these topics. Dealing with debt. According to the Federal Reserve Bank of New York, 70% of average household debt is made up of mortgages. That pretty much makes sense. But that leaves 30% that's made up of other debt like credit cards, revolving debt, auto and student loans, etc. These can carry often fairly high interest rates and create a strain on households. In fact, according to the American Public Health Association, the impacts of debt can affect stress, anxiety, depression, and high blood pressure. Doug, you often talk about getting out of debt the quickest, smartest way. How important is it for someone to get out of debt, and what does that do for them?
Yeah. In fact, I think one of the number one causes of couples splitting up, divorce, comes from financial woes, and a lot of that is directed because of debt. And so getting out of debt, and we'll talk about how I define that, but it relieves the pressure. When you have enough control over money and you have liquidity, you have safety, you're earning rates of return and so forth, which is the L.A.S.E.R acronym that we use, liquid assets safely earning returns. When you can handle any situation when life throws a curveball at you, you can have peace of mind. You can sleep at night. But so many Americans are sort of living on the paycheck they're going to get, 2 or 3 months down the road, and they consume instead of conserve. And so once people can be out of debt and have assets that are liquid and safe that they can draw on, the peace of mind that comes about and the harmony in their relationships, their marriage, their family, the stress goes away. People get high blood pressure because of debt and stress.
Amazing. Yeah, it's amazing. Everyone, I'll go to you on this one as well. What are your thoughts?
Well, like you said, bringing harmony into the relationship. I just doubled down on that. That's why I married Harmony.
A girl named Harmony.
No, this is a really important deal because it's one of the most rewarding things I've sat down with couples. And you sit down with couples and you build them a plan. I mean, I just did this recently with a couple as well, and sitting them down with a plan where they felt like they were probably never going to be able to get out of debt, buy a home. I mean, they felt like they were drowning. Yeah. And by simply giving them direction and the strategy, right? We talk about strategy all the time right there. From never getting out of debt to we got them on a path to where they're going to be out of debt in less than a year. Yeah. Like 12 months. Credit card debt everywhere, signature loans everywhere, car loans everywhere. We'll get that. It's all under control within a year. And now they're saving. They're creating an emergency. They've got an emergency fund. I mean, and you can see the countenance change. I mean, now they're like just always drowning. Now they are confident in their finance. I mean, it's just wonderful to see that countenance change. Yeah. And it's extremely rewarding. Before, like, it's just, they're just, you're like I said, stress. I mean, the stress is extremely high, and now they've got financial confidence, financial freedom.
Yeah, it really is amazing how much that affects people's psyche and emotion, debt and finances, and the stress and worry about that. It wakes people up at night. Brandon, let me go to you. What are your thoughts on this?
Yeah, it's like debt's the ultimate killjoy. right? It can be suffocating. It can cause, obviously tension in marriages and can lead to a lot of pressures and stress that really, I mean, Dave Ramsey, some of his best qualities are helping people get out of debt. And
Absolutely.
he's
IUL.
Yeah.
Oh wait,
not
sorry.
that one. Sorry.
He's a big
But
cut the credit card kind of guy. The snowball debt. I think just get a plan in place. Find something that can help you get out of debt. If you are, because like from a psychological standpoint, it's not healthy. Life insurance companies actually, part of their underwriting with people, they look at stuff like credit scores and hey, if this person's got really bad credit score and they're swimming in debt, that's an indicator that could lead to a shorter life expectancy.
Isn't that amazing?
Yeah, it is crazy.
That is incredible.
They're looking at.
There's a link to that.
Yeah, we had. One insurance carrier was reporting that it's more predictable on life expectancy or credit score than it is your medical records.
That's the amazing.
I mean, your credit score
huh?
dictates your life expectancy more than that, and it's wild.
That's amazing,
right?
That's crazy. Scott, what are your thoughts on this?
Yeah, I think part of the debt side of it, that it just eats you inside if you have all that debt. And I think we've got a good indicator of that happening with our nation right now with the amount of debt Uncle Sam is running up, and the health of our nation is pretty poor right now. So
yeah,
you can see all the people that really, you feel it. You feel it across the entire country.
Yep,
and that's an excellent point.
Yeah, and that's
excellent point.
That's going to segue into our next topic. But I want to stay here for just a little bit, Doug. I want to come back to you. You talk a lot about getting out of debt the quickest, smartest way for someone who has extra money. A very common question that we get is, okay, I have some extra money. Should I take that money and pay off like a low interest debt, like a mortgage, or should I sock that away? Like, which one is going to mathematically be better, or which one's going to be better? What's your kind of take on that?
Well, mine comes from personal experience and also seeing thousands of Americans who they well-intended. They take this extra money and they plow it all against their mortgage because they want to get out of debt, which is a good destination, as we've said. Okay, the problem is they're giving up liquidity, and then all of a sudden they get sick, they get disabled, they get laid off, they lose their job. Something happens that they can't foresee, like a pandemic or whatever, okay? And then they have no liquid cash, and then they realize, wait a minute, I have a whole bunch of equity in this house. I've been paying it down. And then they go to try to get that equity. They either have to sell the house, which is difficult to do because it's not liquid. They don't really want to sell the house. And so, they go to the bank and they try to borrow. But see, banks, credit unions, they loan money based on your ability to repay.
Yeah,
they don't care how much equity you have.
The asset.
And if you lack the ability to repay, they say fat chance.
Right.
And all of a sudden, these people who are sending all these extra principal payments, thinking I'm getting out of debt the smartest, fastest way because they lack liquidity, all of a sudden their home gets foreclosed on because you go 90 days without making a payment, they can start foreclosure proceedings on a trust deed note. And so the extra money, if you had an extra $1,000 a month, I would recommend you sock that away into an account compounding, tax-free is what I prefer, a L.A.S.E.R fund, okay? And in actuality, the compound interest tax-free at a rate of return of 8, 9, 10%, and you have a tax-deductible mortgage, let's say you borrowed at 6% tax-deductible interest in a 25% tax bracket, if you're deducting that interest. People say, we take the standard deduction today. It's still a benefit, but 6% deductible interest is only 4.5%. And you're making double that, okay? You're making 100% more, so you actually will get out of debt faster if you use the money over here in this pocket. But if you get into trouble, you have liquid cash you can access. You can peel off for all those. If it's in the property, it gets trapped in there, and I've seen too many people lose all of that. All of the progress they made in years and years of sending that extra money against the mortgage, they lose it in one fell swoop when they can't make their mortgage payments.
Yeah, that liquidity is such a big deal.
Liquidity.
Liquidity.
That couple I was talking about, I mean, we helped them get on that path, but immediately what happened? Immediately, both cars, a transmission went out, an engine had issues. And all of a sudden they had, and if we hadn't simultaneously tried to get them out of it, but also maintain liquidity. I taught them what my dad taught me, maintain some liquidity. Well, they actually had the money to go ahead and dip into to pay for the repairs rather than to have to put that on a 28% interest credit card.
Yeah.
And it would have just kept on spiraling then.
Right. And never pay it off.
Right. It is it's so important to be able to keep that. And don't sacrifice compound interest to save simple interest. Right. I mean, that's what you're looking at. That mortgage is a simple interest. Don't sacrifice earning compound interest by sending extra principal payments to the mortgage company.
And hats off to Doug. I think this is probably the most amazing thing about what Doug's done is that he took what would have been one of the life's worst lessons, losing your house, and instead turned it around, revitalized the whole IUL industry and teaching people about liquidity, about safety, about liquidity. That liquidity part of it is just amazing how much that has helped so many people out.
Yeah.
And it's too many times people are actually using that money to spend rather than build up protection, wealth, and then help them out financially, marriage-wise, health-wise, and all of that.
Scott, can you show us, some people are, okay, well, how much does it really matter to save money, on a monthly or a yearly basis?
Yeah.
Can you we talked about compound interest and growth. Can you show us an example or how much does it really matter for someone who can just, like maybe a young couple that can just save kind of a medium amount per month or per year? Does that really add up, or how does that,
Let me snap my fingers and we'll go to the table of knowledge and wealth. So. What are we calling it now?
The table of wisdom.
Table of wisdom.
Table of wisdom. There we go.
So Emran, if you can navigate for it. But this is just a very simple example, and it shows someone young. And I think the neat thing with this is the discipline starting also at a young age is huge.
Yeah.
How many times do we get phone calls from people in their late 50s, early 60s? Hey, I'm going to be retiring down the road in 5 years. I need to get started. No, you needed to get started a while ago. But yeah, so here we've got someone who's 25 setting aside as something as simple as $500 a month. So that's $6,000 a year. Now, we've taken the data here on the S&P back to 1980. One of the worst years ever, I think, because someone was born
That's when Emran was born.
But the 70s were a little bit better. But yeah, so you can see back to 1980, just taking some raw data, and then you can see that we build money and grow money. There's a couple of highlights here. In red is the zero, right?
Yeah.
Yeah, or negative years.
Downturns, yeah.
So if you take the negative years there, and then also the positive years, we had some fantastic time. But this also takes into account the lost decade of the early 2000s, 3 years in a row. The only time the S&P's gone negative 3 years in a row, early 2000s. Of course, 2008, COVID, all of that. Oh, can we say that word? I forget. But look at that. By let's see, 65, they've got $1.3 million built up in there.
Yeah.
Do you have to wait till you're 65 to use it, though?
No.
But retirement age.
67.
My wife and I used our first policy to take money out to buy our first home. And so we were able to make that loan. And the neat thing is we still earned interest on that money as if we didn't access that money in the policy. And we bought our first home with that. So
yeah, it looks like at full retirement age, there's almost 2.2 million in there.
2.2.
That's pretty good, right? Socking away $500 a month, 2.2 million.
Now that's $500 a month. And if you imagine, I've got a kid in high school that did this at $500 a month at 18.
Yeah.
I've got a couple of 19, 20-year-olds that are doing that. I've got a 19-year-old saving $1,000 a month. I mean, imagine what his numbers are going to look like.
Yeah, right.
Now, also, don't stop as well. I mean, just because you do one doesn't mean that you're done. Multiple streams of income is important for retirement. So,
yeah, that's great. Emran, thoughts on this? How much does small amounts add up to over time? You kind of mentioned it earlier. Any other thoughts? And then Brandon, we'll go to you.
Yeah, I mean, we achieved this goal because we follow the entire swing:
Yeah.
liquidity, safety, rate of return, and tax benefits. So, I mean, you see the negatives with the S&P 500. Well, in the L.A.S.E.R fund, obviously, you're getting zero as your hero in those years, right? So we don't lose. That's how you achieve this goal, is by eliminating losses.
And by the way, that included fees and expenses in those numbers.
And so you just follow the strategy. When you follow the strategy, you can hit that goal. And not only hit that goal, I mean that $2.2 million when you retire by only socking away $500 a month.
Mm-hmm. And it's
tax
free.
Exactly.
Yeah.
Tax
So
free.
good.
I mean, that is something that I think every young couple can get really behind and get really excited about this.
Yeah.
I mean, this is a bigger, brighter future. And isn't that what they are? I mean, that's what they're looking for. I mean, as they're trying to get out of debt, they're wanting to see, and this is what all the couples that I've met with, when you show them where they can get to after they get out of debt and they can do something like this right here. I mean, it is awesome. It is awesome. That bigger, brighter future.
One thing I want to say
awesome.
on this too is that a lot of times we'll get people call us, well, it's probably too late, right?
Right.
No, it's better to start. The old saying goes, when is the best time to plant a tree?
Today.
20 years
ago, yeah.
When's the next best time? Today.
Yeah.
So
That's great.
just getting going and getting disciplined. That getting disciplined rather than spending $500 a month, save it.
Yeah, and I love how you mentioned, Scott, you don't have to wait till certain, you use these, for helping purchase home, things like that. Brandon, and Emran talked about liquidity. Can you use this for things like college savings, business purposes, other things like that?
Absolutely, yeah. I mean, I have clients that use it to, I have a client that use it to buy into a chiropractic clinic. Some that have used it for Disney trips, for a car, for student loans or not loans, to pay off student loans or just pay for tuition. So I love that it's, you're basically just hitting a lot of singles with this strategy. You're not swinging for the fence. You're not trying to hit, the home run or the grand slam. It's just it's a nice, predictable, kind of a forced savings plan, which is what is really effective, I think, when you're younger on, because you set it up automatically where it just drafts out. And if you've run into any financial snags, with these plans, you can hold off, or
there's
decrease.
flexibility.
There's so much flexibility, and we don't need to get into that now. But by the time, you look at 65, how many clients I sit down with, and then they're saying, yeah, I got $2 million and it's sitting in IRAs or 401ks. Well, you don't have $2 million. Uncle Sam has a big chunk of that. You don't own all that.
Yeah.
And you look at this, that's all 100% tax-free. So the beauty of that number there at 65 is hit a bunch of singles. There's nothing they had to do to try to, do anything to create a miracle for this retirement. They just were smart, socked away.
Yeah.
And it's all theirs now. It's all tax-free.
Tax-free, as long as it's structured properly and executed properly. Doug, wrap us up on the final word on this subject.
Well, again, number one is to stay liquid and have your money safe because of emergencies. And my feeling of out of debt, based on what I said, is when I have enough money, liquid assets that are safe, that any time I could transfer them and pay off any debt, I am out of debt. But see, I'm in control. And that's why I said, a lot of times people say, I just want to take out a 15-year mortgage instead of a 30-year mortgage. And I proved in my very first book, which would now be a $100,000 mistake for most Americans, because you take the differential between a 30-year amortized mortgage payment, which is lower, and a 15-year, which is higher. Take that difference plus the tax savings you will achieve during the first 15 years of a 30-year mortgage, and you put that into an account like this. You will actually pay off the 30-year mortgage in 12 and a half years.
Nice.
Instead of 15 years, by using compound interest with liquid access versus the simple interest that's tax deductible usually over here. A lot of people say, a mortgage isn't simple interest, it's compound. No, if you have a negative AM loan where they charge you interest on top of your interest, that's compound interest they're charging. No, a mortgage is simple interest,
they don't
tax
charge you
deductible.
interest
It's
on your
not
balance.
compounding.
Yeah.
Okay.
Yeah. Right.
It doesn't keep growing. It goes down slowly, but it's compound interest versus simple interest.
Yeah, that's awesome. All right. Well, coming up, what's the difference between tax-free and tax-deferred? But first, just a reminder that if you enjoy this content and you want to see more of it, please like and subscribe. And hey, ask us a question or comment. We may use it in one of our next shows. All right. Speaking of debt, let's talk about the U.S. government.
Ouch. Do we have to?
As of this podcast, the U.S. debt is nearly $37 trillion in debt. And by my count, looking at it, it looks like it's going up about $100,000 every 2 seconds. That's nuts. Sometimes as Americans, we get lost between billion with a B and a trillion with a T. We just can't comprehend those numbers. Brandon, let's start with you on this. Can you help us understand the difference between billion and trillion and how significant $37 trillion is?
I mean, it's hard to wrap your brain around it.
Yes.
It really, truly is. And so let me just give you a couple of examples. If you
Hold on. It just went up by 10 million.
The debt just increased.
It just went up by 10 million.
It will go up another 10.
Ouch.
But if you took dollar bills and you stacked them end to end from here to the moon and back, that would be $1 trillion.
200 times.
200 times.
Here to the moon and back 200 times is 1 trillion.
Well, I was only 100.
Yeah,
you're about 200 times off.
Boy, where'd we get this guy from? Huh?
All right, so 200 times. Now, that's hard to wrap your brain around.
Yes,
like even just one time.
Yeah, just one time was hard. 200
200 times. That's 1 trillion. So, if you look at that number, debt per citizen, $107,000. If every citizen of the U.S. had their fair share, but we know not every citizen is a tax-paying citizen, right? So if you broke that down to tax-paying U.S. citizens, the debt per tax-paying citizen, and Doug, correct me if I'm wrong, is approximately about $360,000-ish.
Yeah, it's almost that over there on the top right.
Okay.
323,000.
323,000. So if you are wanting to do your part for Uncle Sam and pay your fair share, your tax paying, write a check for 323,000, and we just wipe it out, and then in a couple of years we'll probably be right back to where we were
U.S.
before.
citizens could do it like that. That'd be easy.
I mean, my son Ethan's just sitting over there. Ethan, you see that, buddy? You got 107,000 until you graduate, and then it jumps to 323,000. So hope you're ready, buddy. Hope you're ready.
Well, I asked ChatGPT to do a comparison of how the government runs its debt and deficit versus the average American. Okay, this is crazy. Are you ready for this? All right, the U.S. government spends 122% of its revenues, meaning it spends 22% more than what it makes each year. And with a total debt to income ratio of 640%. The average household, on the other hand, spends about 76 to 82% of its income on expenses, with most households avoiding a deficit altogether. Scott, as a lifelong fan of the government,
love it.
Should we be worried about the U.S. deficit habits?
Yes. Yeah, no, absolutely. And I think we're, again, paying the price for that. And we saw the price is a lot. In fact, it's now probably 500,000 by the time we're done talking about this. But this is a lot like parents with children. And our parent is the government, and its children are not healthy either.
Yeah.
Financially. And there's a lot of similarities there. I think also the part that doesn't reflect it right is the annual debt. I think that's new debt, but if you look at their credit card debts and things like that, that's probably a lot more in there as well. So, we are struggling as a nation, both as a nation and as people, because of that bad spending habits.
Yeah. Well, and because of this, so most Americans, and this includes younger Americans, they're using vehicles like IRAs and 401ks. However, there's not really hard data on this, but it's evident with trends that we're seeing. A growing number of people, especially young people, are using tax-free accounts like Roths and IULs. Emran, why do you think that's the case? We're seeing younger as we're looking more to the younger generation. They're more looking to tax-free things like Roths and IULs. Why is that?
Well, I mean, I could bring Ethan over here. We could ask him, but I think it's because he sees in his generation, they see the numbers.
Right.
Math doesn't lie. And they know, I mean, it's just simple. Thank heavens, common sense might be coming back into our society a little bit, knowing that this debt is there, and the only way the government collects this money primarily is through what? Taxes. And so they know the taxes are coming.
Right.
They're hitting them. They're seeing their own parents, their grandparents retiring, and the amount of taxes they're paying in retirement is not what they thought it was.
Right.
It's so much more. It's their largest bill in retirement. If you calculate the amount of taxes you pay from the time you retire to the time you die, it's probably the largest bill during that time of your lifetime.
That's a lot of money.
And so, I mean, luckily these kids are smarter. They're looking at like, hey, if I can eliminate or reduce or manage the largest bill in my retirement years, what would that do? Right. And we've even got examples if we want to, take a look at that. If we want to look at
I want to do that another set. How much total tax does the average person pay from retirement to death? What's that average?
Right.
Yeah, it's really great. Doug, final thoughts on this?
Well, the young people, I think they're realizing that the common thing that I still heard from so many financial advisors, keep defer, which means procrastinate.
Right.
To some future perceived unknown advantage. You'll likely be in a lower tax bracket then. Right. And the younger people can say, no, you're not.
No.
In fact, I go speak throughout the country, and the younger people, when I say, how many of you think the taxes in the future will likely be lower?
Yeah.
I get nothing but crickets. How many think they're going to be the same, one or two? How many think they're going to be higher? And they all raise their hand.
Right.
And so then they go, it would be better to pay tax on the seed money, okay? If you're a farmer and you have the choice of buying your seed in the springtime, and you don't have to pay tax on the price of the seed, you plant, you irrigate, you cultivate, and then in the fall you go to harvest your crops, and now you agree to pay tax. That's a traditional IRA or 401k.
Right.
If you knew you were going to be in a lower tax bracket, that might be wise. But they're realizing, no, the government keeps overspending, and they're going to have to raise taxes, and it would be better to just pay the tax on the seed and enjoy the harvest without tax, and that's why they're looking at Roths.
Yeah.
And IUL, when they really learn about IUL, it has the two benefits of a Roth and 4 additional benefits Roths will never have, and that's they're smart. They're smarter.
Yeah, politicians just keep passing the buck. And so the young generation's like,
they know it.
You can pass the buck, but I'm out of the game. I'm going to get out of it.
Yeah, because my guess is if you ask the same question, if you ask someone approaching retirement, is Social Security going to be there for you? You might get a mixed kind of reaction. But if you ask younger people, the younger generation, like 20s, 30s, hey, is Social Security going to be there? Is it all going to be there? That's where I think you'll get a similar response. Right? There's no confidence. All right. Well, if you're enjoying this content and are wondering how to take advantage of these ideas, L.A.S.E.R Financial helps individuals and families like yours implement proven strategies to grow and protect your wealth. One of our most powerful tools is the Index Universal Life Policy, or IUL. It's not just insurance, it's a tax-free retirement strategy, a way to grow your money with compound interest, and a safety net against market downturns. Imagine being protected from market losses while still participating when the market goes up and having tax-free income that allows you to keep more of what you've worked so hard to save. Go to laserfinancial.com or call 801-505-0409 to schedule a free consultation and see how these strategies can work for you. That's laserfinancial.com or call 801-505-0409. Don't wait. Take the first step toward a brighter, more secure financial future today.
And tax-free.
Are you a financial professional wondering how you can expand your business working with Index Universal Life, or IUL? Are you leveraging IUL to its full potential? That's where IUL Insiders comes in. In the upcoming weeks, they're hosting the IUL Challenge. It's a free 3-day event designed specifically for financial professionals to help you build a thriving, scalable business that sets you apart from the competition. You'll learn proven strategies to market, design, and sell properly structured policies that deliver incredible results for your clients and your bottom line. If you're ready to evaluate or elevate your practice and scale your business, visit IUL IULchallenge.com/93 to save your seat. Spots are limited, so don't wait. That's IULchallenge.com/93. Take your business to the next level. Okay, tax-free versus tax-deferred. I'm a little distracted here. Well, we've talked about getting out of debt and saving money. And we've also talked about how more Americans are saving money in tax-free vehicles versus tax-deferred or taxable vehicles. Emran, what's the difference between tax-free income and tax-deferred income in retirement? We just talked about more people turning to that, but what's the actual difference? Can you give us some illustrations?
Yeah, let's actually go back to the wisdom table, and let's go back to even Scott's example here earlier.
Great.
Okay.
So as we look at that lav mic,
let's get that live mic on. Can we turn his lav mic on? Okay, there we go. Perfect. Okay, go ahead, Emran.
Okay, so here we were with Scott's example where they were going to retire around 67 to 70. They got $2.2 million, right?
Yes.
This is going to be that tax-free harvest. I'm going to back out over here and actually, sorry, let me grab that. And we're going to come over to this one here. Same example here. We're getting down to that age 70. But now I'm going to go ahead and let's go ahead and compare this. Okay, so we're going to compare this. I've got a taxable. Oops, right there. Let me get a highlighter instead. Okay, we've got the tax deferred account right here. Okay, so this is the tax deferred account along the line right here versus our tax free harvest, our IUL,
tax deferred,
sitting right here.
IRAs, 401ks.
Yeah,
correct.
That's a good point.
Now, again, what we're going to do is we're going to put the tax-deferred account straight into the S&P 500, right?
Okay.
Keep it nice and easy, keep it simple. Then we're going to put the IUL, index it to the S&P 500. We're moving forward. Okay, as we get down here towards retirement, I mean, what one thing you're looking for is obviously creating the strategies that we talk about. You know, when we hit here, we're looking at, once again, you got that $2.2 million. They're only sitting at $1.1 million.
Wow.
Okay. And then as you get up here right here, you're sitting at age 70. Okay, at age 70, they're at 1.5 million. We're at 2.6 million. So we got about $1 million more. But more importantly, it's when you go to access your money.
Right.
I always ask people all the time, you know, why do you save your money?
Right.
Why do you grow your money? The purpose behind why we do this is so that we can access it. So this is where you need to always make sure in any financial plan, I think everybody needs to talk about accessing that money. So when we talk about accessing this money, let's go ahead and look at accessing the money. Okay, and when you access the money, this is why young people are understanding why to go to a tax-free harvest.
Yeah.
Because in my taxable account, I start pulling out $192,000 net. That means that's what I get to spend, right? I pay taxes, I get to spend $192. Okay, if I spend that, I had my tax deferred account right here, and then you go year by year. What's happening?
It's going down quite a bit.
Yeah, it's going down, especially if I have a negative year in the S&P 500. I lose that money, and then I'm going to lose again because I got to take out a withdrawal.
Yeah.
I still have to live.
Right.
And so I'm taking double losses those years, and what happens? They are out of money. Okay, if they retired at age 70, they had a 10-year retirement.
Wow.
Young people know they're living longer as well. I mean, I think some of the statistics even show like a baby girl born this year is expected to live to age 120. A 10-year retirement is not realistic. I mean, you're going to go beyond that. And so obviously when they ran out of money, what did we have? We had almost $7 million earning interest for us. We still had access to $4 million, despite pulling out $200,000 every single year. Mm-hmm. You know, and that lasts all the way. I mean, you go all the way to age 100 right here, and we're still sitting at $8 million. $8 million, a tax-free harvest giving you $8 million, okay, versus the taxable harvest. It ran out of money years ago, 20 years ago. And this is, the math doesn't lie, and this is another perfect example. And again, we're not losing our ability to continue that 93 million, right? We're pursuing that miracle of compound interest always inside of this IUL as well. That's one thing you want to, that's what allows this to happen right here. But on top of that, it's really that tax-free harvest. That tax-free harvest versus that taxable harvest. It rears its head when you look at taking out income. So always, whenever you're looking at your long-term financial planning, always talk about accessing money and what that does to your accounts when you start actually touching it.
Now, the tax rates in this, Aaron, this is amazing. first of all. The tax rate, when you use the tax rates for this, did you estimate taxes going up down the road, or it's kind of current projection of tax rates?
You know what? We did not increase taxes down the road. We did actual
current tax rates.
Current. I put somebody.
So if tax rates went up, it would look
Yep.
even worse for the tax-deferred
Yep, I put
account.
somebody like in a 22% tax bracket. If they had 200 grand tax free, that's going to be more.
That's
like,
going to be a little bit more,
well,
right?
a little bit more like in
Sure.
a 24% tax bracket plus your state income tax rate. But no, this is just a current tax.
Well, one thing we're missing out on this example, though, here at age or year 58, age 82, I think it is. If they run out of money, they still have Social Security 58 years from now.
Do they?
Or maybe
they
not.
don't. And by the way, 85% of Social Security will be taxed as well.
Yeah.
Up to 85%, depending on their income.
They'll
Exactly.
still have charity welfare or their children to support them.
That's true.
There you go.
Okay.
Yeah.
Pull out that calculator on the debt and see what it is 58 years from now.
Oh, I don't even want to know. What are the CBO estimates that go out 60 years, 40 years? Those don't exist, right? But that would be something else.
It'd just be red.
Yeah, it would just be a bloodbath. Brandon, how did Emron do? That's pretty good. Any thoughts on this?
Brilliant. I mean, like you said, the numbers speak for themselves, and it's so powerful to have these tools and instruments that people have access to, where you can have tax-free. I mean, you think about as you're claiming income at the end of the year in retirement. I want a huge portion of that to be not even recognized as income from Uncle Sam. And it's not some tax evasion.
No.
It's not a loophole.
No.
These are tax codes that have existed for 100 years.
Right.
It's just knowing how to properly structure these plans.
Yeah.
And I want to have as low as taxable income as anyone when it comes to retirement. And these are the vehicles. It's Roth and it's max funded IULs. But max funded IULs, there's so many more additional benefits and perks in my humble opinion. I know if there's a market crash, we're going to have, we're talking about taxes in the future. How many market crashes? How many recessions? Is there going to be
the unexpected?
Could there be a Great Depression again in my lifetime? Who knows? But the chances are there's a good likelihood. Where's my money at? Is it protected? Is it safe? Is it guaranteed? I can't lose a penny if the market crashes. I know in the Roth, I'm subject to that kind of volatility.
Right.
So
yeah. Roth's
with,
just
with
a container.
this, I'm so much safer.
Yeah.
Remember that segment of where we talked about the head of the SEC and he's got over 50 IUL
Yes,
policies?
that's a great
You
callback.
can't tell me he doesn't know this.
He did not know it. And they're all universal life, if I remember right.
Yep.
The article said they're universal life.
Does he understand about the debt of the nation? I mean, he understands a lot.
Paul Atkins, head of the SEC, I think.
Yep.
Yeah, chairman of the SEC.
Yep.
That's a great callback. Doug, how'd your son do? Wrap us up on this. What are your thoughts?
He actually did really quite well.
I applied your principles.
He doesn't have his brother to compete against. So the competition level's a little lower, but he just still did okay.
When you super simplify this, let's take $1 million nest egg at age 65, 67. Now, the unfortunate thing, which is unacceptable to me, is that the financial services industry wants you to use a 4% rule. Okay. They only want you to pull $40,000 a year out of that million. Even in a 25% tax bracket, you're only netting $30,000, 3%. That's pathetic.
Ouch.
So let's give them the benefit. Let's say 10%. You all know that a properly structured max funded IUL, pulling out the money the smart way, we oftentimes get not just an 8% payout, but many times a 10% payout that will last to age 100, age 120. That $1 million nest egg, you pull out $100,000 a year, tax free.
Yeah.
Okay. Now, if money in an IRA or 401k, tax-deferred account, to net 100, okay, taxes will likely be higher. In a 33% tax bracket, you have to pull out 50% more.
Yeah.
So in our illustration, they have to pull out $150,000, pay tax of a third, 50 to net 100, and that $1 million nest egg is gone in 11 years, just like this one was gone in 10 years.
Amazing.
And now they're relying on Social Security, welfare, charity, or their children for support. Whereas the max funded IUL keeps going to age 95, age 100, age 120, and it stays ahead of inflation because it's tax free. It dwarfs traditional IRAs or 401ks invested in a volatile market.
It reminds me of an analogy of a battery versus a generator.
Oh, yeah. So many people are trying to charge up this retirement battery, hopefully that it won't go dead before they do.
Right.
What shorts out
They
IRA,
won't
401k batteries?
outlast their money. Yes.
Taxes, inflation, and market volatility.
Yeah, that's right.
Make yourself immune from those.
The 3 obstacles. Well said. All right. Well, hey, just a reminder that if you enjoy this content and you want to see more of it, please
I'm
like
enjoying it.
and
This is
subscribe.
actually really
Well,
nice.
please like and subscribe. We want to hear from you, see from you, ask us a question, comment. We love it all. Okay. Well, that's all the time we have for today. Avoid the pitfall of debt and unnecessary taxes, and we'll see you next time on 93 Million. Thanks, everybody.
See ya.